Good evening. Something extraordinary is happening in the silver market right now. And if you hold precious metals, or if you've been waiting for the right moment to enter this space, what I'm about to share with you matters deeply. Silver premiums in India have exploded to over $8 per ounce above the COMEX spot price. Let me put that in perspective for you. We're not talking about the typical $1 or $2 premium you might see during normal market conditions. We're talking about a premium that has quadrupled or even quintupled in a matter of weeks. This isn't noise. This isn't a glitch. This is a signal. India is the world's second largest consumer of silver, behind only the United States. When premiums in a market of this magnitude spike to these levels, it tells us something fundamental about the relationship between paper silver and physical silver. It tells us something about supply chains, about demand patterns, and about the increasing strain in the precious metals complex. But here's what I want you to understand from the very beginning. This script is not designed to make you panic. It's not designed to convince you to rush into the market tomorrow morning without thinking. And it's certainly not designed to predict short-term price movements that no one, including me, can reliably forecast. What I'm going to do instead is walk you through what's actually happening, why it's happening, what it means for the broader market structure, and most importantly, how you should think about positioning yourself, whether you already hold silver or whether you're considering an entry point. We're going to approach this the way serious investors approach every major market development, with calm analysis, with historical perspective, and with a clear understanding of both opportunity and risk. So let's begin. First, let's establish what a premium is and why it matters. The COMEX silver price is a paper price. It's the price at which silver futures contracts trade on the Chicago Mercantile Exchange. When you see the silver price quoted on financial news networks, they're almost always referring to this COMEX price. But COMEX isn't where most retail investors or institutions buy physical silver. That happens in local markets, through dealers, through mints, through refineries. And in those markets, you pay a premium above the spot price. Under normal conditions, these premiums reflect the basic economics of the physical market. Transportation costs, refining costs, dealer margins, import duties, storage, insurance. These are the real-world expenses that separate paper trading from physical delivery. In India, a typical silver premium might range from $1 to $3 per ounce during calm periods, sometimes less, sometimes slightly more. But these are predictable, stable costs that reflect ordinary business operations. When premiums suddenly explode to $8 or more, something has fundamentally changed. The premium is no longer just covering costs. It's reflecting scarcity. It's reflecting urgency. It's reflecting a breakdown in the normal flow of physical metal from sellers to buyers. Now, why does India matter so much? India's silver consumption is driven by several powerful, deeply rooted factors. Cultural factors, religious factors, economic factors, all of them converging to create consistent, substantial demand. In Indian culture, silver holds profound significance. It's used in religious ceremonies. It's given as gifts during weddings and festivals. It's worn as jewelry. It's seen as a store of value that families can pass down through generations. Unlike gold, which has become extremely expensive for many middle-class Indian families, silver remains accessible. It's the precious metal that working people can still afford to accumulate, and they do accumulate it, steadily, year after year. India also has limited domestic silver production. The country produces only a small fraction of what it consumes. This means India is heavily dependent on imports, primarily from countries like Mexico, Peru, and the United States. When those import channels face disruption, when global supply tightens, when logistics become strained, India feels it immediately. And the premium structure reflects that stress instantly. Let's talk about what might be driving these premium spikes beyond just strong demand. Global silver production has been relatively flat for several years. We're not seeing major new discoveries. We're not seeing massive production increases. In fact, many silver mining operations are byproducts of other mining activities, particularly copper and lead zinc operations. When those primary metals face their own challenges, silver production suffers as a consequence. Meanwhile, industrial demand for silver continues to grow. Solar panel production, electronics manufacturing, electric vehicle components, medical applications. These industrial uses are not discretionary. They're embedded in critical supply chains for the energy transition and technological advancement. So we have relatively static supply meeting growing industrial demand, plus consistent investment demand, plus cultural demand from major markets like India. Something has to give. When refineries can't keep up, when shipping routes face delays, when import paperwork stalls, when dealers run low on inventory, premiums rise. They rise because buyers are competing for a limited pool of available metal. They rise because the next shipment might be weeks away. They rise because uncertainty makes people willing to pay more to secure what they need. Here's where things get particularly interesting and potentially concerning, depending on your perspective. The COMEX market trades enormous volumes of silver contracts every day. The vast majority of these contracts are settled in cash, not physical delivery. Traders are speculating on price movements. They're hedging other positions. They're playing arbitrage games between related markets. This system works smoothly as long as most participants are willing to settle in cash, but it creates a potential vulnerability. What happens when too many contract holders decide they actually want physical delivery? The system isn't designed to deliver physical metal to everyone who holds a contract. The amount of registered silver inventory available for delivery on COMEX is a fraction of the total open interest in contracts. Now, I'm not suggesting COMEX is about to collapse or default. That would be speculation, and irresponsible speculation at that. The exchange has mechanisms to handle delivery pressures. Banks and dealers have inventories. The system has weathered stress before. But what we're seeing in India, and what we've been seeing in other physical markets around the world, is a growing recognition that paper claims on silver are not the same thing as physical silver in your possession. When premiums spike to $8, what the market is telling you is this: people with money are willing to pay significantly more than the official spot price to get their hands on actual metal. That spread represents the market's assessment of paper versus physical risk. Let's ground this in history, because nothing we're seeing is entirely unprecedented. In early 2020, during the initial COVID pandemic lockdowns, precious metals premiums exploded. Silver premiums in the United States reached levels we hadn't seen in decades. Dealers were selling out of inventory. Wait times stretched to months. Premiums approached $10 per ounce in some retail channels. Why? Because refineries shut down. Because transportation ground to a halt. Because people suddenly wanted the security of physical assets when the entire world seemed to be unraveling. The premium eventually normalized as supply chains recovered. But for months, there was a severe disconnect between the paper price and what you'd actually pay to buy physical metal. We saw similar dynamics, though less extreme, in 2008 during the financial crisis. We saw it in 2011 during the European debt crisis. And we saw it in 1980 during the Hunt brothers silver manipulation saga. The pattern is consistent. When systemic stress emerges, when confidence in financial institutions wavers, when supply chains fracture, premiums on physical precious metals rise, sometimes gradually, sometimes explosively. What makes the current situation noteworthy is that we're seeing these premium spikes without an obvious crisis moment. The stock market isn't crashing. Banks aren't failing. We're not in lockdown. This suggests the premium isn't just panic buying. It's structural. It's reflecting underlying supply constraints and sustained demand that may persist, regardless of short-term headlines. You cannot understand precious metals movements without understanding the macroeconomic environment we're navigating. We've just lived through the most dramatic monetary expansion in modern history. Central banks around the world printed trillions in new currency. Interest rates were held at zero or below zero for years. Governments ran unprecedented deficit spending. Now we're in the aftermath. Inflation emerged, though it's moderated from its peaks. Central banks raised rates aggressively, then paused. Now they're cutting again. Debt levels, both government and private, are at historic highs. Currency volatility is increasing. In this environment, people naturally look for assets that aren't someone else's liability. Gold, silver, real estate, commodities, things that exist independently of the financial system's promises. Silver occupies a unique position. It's a monetary metal with thousands of years of history as currency. But it's also an industrial metal with irreplaceable applications in modern technology. This dual nature makes it responsive to both investment demand and industrial demand. When investors worry about currency debasement, they buy silver. When solar panel production increases, manufacturers buy silver. When jewelry demand in Asia rises, they buy silver. All of these demand streams flow into the same relatively small market. The total value of all silver ever mined is dwarfed by the market capitalization of a single large technology company. It's a small market, and small markets can move dramatically when new capital flows in or supply tightens. The India premium spike is part of a larger story about precious metals market structure under stress. For decades, the paper markets have dominated price discovery. Whatever COMEX says is the price became the global reference point. Physical markets generally tracked COMEX with modest, predictable premiums. But increasingly, we're seeing physical markets assert their own pricing power. When someone in Mumbai needs silver for an upcoming wedding and is willing to pay $8 over spot, that's a real economic signal. It's not speculation. It's genuine demand meeting constrained supply. If this pattern persists, if premiums remain elevated not just in India but in other major markets, it suggests we may be entering a period where physical prices partially decouple from paper prices. Again, I'm not predicting anything extreme. Markets adapt, arbitrage opportunities bring systems back into balance. But the magnitude of the current premium tells us the normal arbitrage mechanisms are strained. Perhaps import restrictions are limiting arbitrage. Perhaps financing costs make it uneconomical to exploit the spread. Perhaps logistical challenges create bottlenecks. Whatever the specific reasons, the premium persists because it can't easily be arbitraged away. This is information. Information about the real state of the physical silver market beneath the paper price we all watch. If you already own physical silver, this premium spike raises several questions. Now, let me address the most important ones. If you're holding physical silver in India or a market showing similar premiums, you're sitting on an asset that's worth significantly more than the spot price suggests. The temptation to realize that premium might be strong. Here's how I'd think about this decision. First, why did you buy silver in the first place? Was it for short-term profit? Was it as insurance against currency debasement or financial system instability? Was it for long-term wealth preservation? If your thesis hasn't changed, if the reasons you bought silver are still valid or even strengthening, selling just because premiums are high might mean you're giving up your insurance policy right when it might matter most. Elevated premiums often signal that physical metal is hard to find. If you sell today and then decide you want back in 6 months from now, you might face even higher premiums. You might face scarcity. You might face prices that have moved against you. On the other hand, if you bought silver purely as a speculation, if your financial situation has changed, if you need liquidity for other purposes, selling into a strong premium can be perfectly rational. The key is intentionality. Don't sell because you're nervous. Don't sell because someone on the internet told you to. Sell because it fits your broader financial strategy and personal circumstances. For those with diversified portfolios, an $8 premium might represent a significant change in your asset allocation. Let's say you targeted precious metals as 10% of your portfolio. If silver has appreciated substantially and premiums have exploded, you might now find that allocation has grown to 15 or 20%. From a disciplined portfolio management perspective, that might warrant some rebalancing. Selling a portion of your silver to bring your allocation back to target and deploying those funds into other asset classes that haven't appreciated as much. This isn't market timing. This isn't trying to predict tops and bottoms. It's maintaining the risk profile you designed your portfolio to have. However, during periods of structural market stress, mechanical rebalancing can work against you. If you're holding precious metals precisely because you believe other assets are overvalued or risky, cutting your precious metals position to buy more of those risky assets doesn't make sense. You need to think through your rebalancing rules in the context of your macro outlook. If nothing fundamental has changed in your assessment, perhaps you tolerate a higher precious metals allocation than you normally would. Higher prices and premiums mean your silver holdings represent more value. This is a good time to reassess your storage and security arrangements. Is your metal stored safely? Is it insured? Do too many people know you have it? Are you maintaining appropriate operational security? I don't say this to make you paranoid. I say it because wealth attracts attention, and taking sensible precautions is part of being a responsible asset holder. If you're keeping everything at home, consider whether some should be in professional vault storage. If everything is in one location, consider diversifying locations. If you haven't updated your insurance, do it now. These aren't exciting decisions. They're boring, prudent, protective actions that serious investors take when their asset values increase materially. Depending on your jurisdiction, selling physical silver may trigger tax consequences. In many countries, precious metals are taxed as collectibles at higher rates than stocks or bonds. Before you make any selling decisions, understand what your after-tax proceeds will actually be. That $8 premium might look compelling, but if a significant portion goes to taxes, the net benefit may be less exciting. This isn't advice to avoid paying legitimate taxes. It's advice to make informed decisions where taxes are one factor in the equation. In some cases, you might be better off holding for longer-term capital gains treatment. In other cases, the current opportunity might be compelling enough that paying short-term rates makes sense. Talk to a tax professional who understands precious metals. Don't make substantial selling decisions without understanding the full financial picture. Here's something they don't teach in finance textbooks, but every experienced investor learns eventually. The hardest part of holding an asset isn't buying it. It's watching it go up and not selling too early. It's watching it go down and not panicking. Right now, you're facing the first challenge. Premiums are high. Maybe prices are elevated. The temptation to lock in gains is powerful. But if you sell now and silver continues to run, if premiums expand further, if the fundamental tensions driving current conditions intensify, you'll face regret and possibly the urge to chase the market back up at worse prices. I can't tell you whether to hold or sell. That depends on your individual circumstances. But I can tell you this. Whatever you decide based on analysis and strategy, not emotion. Write down your reasoning. If you're holding, write down what would need to change for you to sell. If you're selling, write down what would need to happen for you to buy back in. This written record will help you avoid the whipsaw of emotional decision-making that destroys more wealth than any market crash. If you don't currently own silver, but you're watching these premium developments with interest, you're probably wondering whether now is the time to enter or whether you've already missed the opportunity. Let me give you a framework for thinking through this decision. Yes, premiums are elevated. Yes, prices may be higher than they were a year ago. But here's what you need to understand about disrupted markets. Sometimes the premium itself is the signal. When physical markets are willing to pay dramatically more than paper prices suggest the metal is worth, they're telling you something about scarcity, about demand strength, about the stress in the system. If you believe we're in the early stages of a longer-term precious metals cycle, if you believe the supply-demand fundamentals support higher prices, if you believe the macroeconomic environment favors hard assets, then entering now, even at elevated premiums, might be justified. Think of it this way. If you buy today at a spot price of $28 with an $8 premium, your all-in cost is $36 per ounce. That's expensive relative to recent history, but if spot moves to $40 and premiums normalize to $2, your metal is worth $42. You've made money despite buying at an elevated premium. Conversely, if spot falls to $25 but premiums remain high at $6, you haven't lost as much as the paper price suggests because the physical price you could sell at is $31. High premiums can actually provide some downside protection if they persist. The premium acts as a cushion between paper price volatility and what you actually pay or receive in physical markets. If you've been waiting for the perfect entry point, I have news for you. The perfect entry point doesn't exist. What exists is disciplined accumulation over time. Rather than trying to time a single large purchase, consider building your position gradually. Buy a fixed amount monthly or quarterly regardless of price fluctuations. This dollar-cost averaging approach removes the emotional pressure of trying to call bottoms and tops. Some purchases will be at higher prices. Some will be at lower prices. Over time, you'll achieve an average cost that's somewhere in the middle of the range. Yes, this means you'll buy some silver during premium spikes, but you'll also buy during any corrections or normalizations. The discipline of consistent accumulation tends to outperform the anxiety of trying to time perfect entries. Set an amount you can comfortably allocate to precious metals. Divide it into regular purchases. Execute without overthinking. This is how patient, successful investors build positions in any asset class. If you're new to physical silver, you need to understand the different forms available and their respective premiums. Government-minted coins like American Silver Eagles or Canadian Maple Leafs typically carry the highest premiums. You're paying for the guarantee of the mint, the recognizability, the quality assurance. Generic rounds or bars carry lower premiums. You're getting the same silver content, but without the government backing or widespread recognition. During premium spikes, these differences become more pronounced. A Silver Eagle might carry a $15 premium, while a generic round carries an $8 premium. For investment purposes, silver content matters most. That generic round is just as much silver as the minted coin. Unless you specifically value the collectability or worldwide recognition of government coins, you might be better served buying lower premium products during high premium environments. That said, when you eventually sell, government coins often have better liquidity and can command higher premiums in return. There's no single right answer, just trade-offs to consider. Before you buy physical silver, have you thought through the infrastructure of ownership? Where will you store it? How will you transport it? How will you secure it? What's your insurance situation? Have you told anyone who shouldn't know? Do you have a plan for eventual sale or bequest? Physical precious metals aren't like stocks in a brokerage account. They require physical space, security considerations, and logistical planning. Some investors use professional vault storage. You pay annual fees but avoid the home storage risks. Some split holdings between home and vault. Some keep everything at home in a high-quality safe. None of these approaches is wrong, but failing to think through these issues before buying is a mistake. Don't accumulate thousands of dollars in metal without a solid plan for how you'll manage it. Let me be clear about something. Buying paper silver through ETFs or mining stocks is not the same as owning physical metal. ETFs like SLV provide price exposure, but you don't own the underlying metal. You own shares in a trust that owns metal. During extreme stress, that distinction might matter enormously. Mining stocks give you leverage to silver prices, but also expose you to operational risks, management risk, geopolitical risk, and equity market risk. A silver miner can perform poorly even when silver prices rise if the company is poorly run. If your thesis is specifically about having physical metal as insurance against financial system stress, these alternatives don't fulfill that objective. If your thesis is about capturing silver price appreciation and you want the convenience and liquidity of securities, these alternatives might be appropriate. Again, understand what you're buying and why. Match your investment vehicle to your actual objective. I'm going to be direct with you about something. I cannot tell you whether next month will bring higher or lower premiums. No one can. Markets are complex adaptive systems. They're influenced by countless variables, many of them unknowable or unpredictable. Anyone who claims to know exactly what happens next is either delusional or dishonest. What I can tell you is this. If you believe in the long-term case for precious metals, if you believe the macroeconomic environment supports eventual higher prices, if you believe owning physical hard assets is prudent diversification, then specific entry timing matters less than you think. 5 years from now, the difference between buying at a $6 premium versus an $8 premium will be noise. What will matter is whether you had the discipline to be positioned or whether you waited forever for the perfect moment that never came. Perfect is the enemy of good. Good enough at the right general time beats perfect timing that never happens. Let's talk about the behaviors that destroy wealth during precious metals cycles. I've watched these patterns repeat over decades. Learn from others' mistakes rather than making them yourself. The biggest destroyer of wealth isn't bad markets. It's emotional reactions to markets. Buying in panic when prices spike and everyone is excited. Selling in fear when prices drop and sentiment turns negative. Chasing performance. Running from volatility. Every one of these emotional reactions tends to buy high and sell low. The exact opposite of what creates wealth. When you feel an urgent need to do something right now, that's usually the worst time to act. Urgency is not your friend in investment decisions. If you're feeling euphoric about precious metals, you're probably late. If you're feeling terrified, you're probably close to a bottom. If you're feeling bored and indifferent, you might be at the right time to accumulate. Markets punish emotion and reward discipline. Internalize this or pay the price repeatedly. Some people fall in love with their thesis. They become convinced silver is going to $1,000 per ounce. They put everything into precious metals and wait for their fortune. This is gambling, not investing. No matter how compelling your analysis, no matter how convinced you are, concentration risk can destroy you. What if you're right about the direction but wrong about the timing? What if the move takes 10 years instead of 2? What if you need liquidity for an emergency before your thesis plays out? Precious metals should be a component of a diversified portfolio, not the entire portfolio. Even if you're very bullish, maintain balance, have liquidity, have income-producing assets. Don't bet everything on one outcome. The goal is to survive and prosper across multiple scenarios, not to hit a home run on one specific forecast. Let me be absolutely clear about this. Do not buy precious metals on margin. Do not use leverage. Do not borrow money to buy silver. I don't care how convinced you are. I don't care how good the opportunity looks. Leverage turns volatility into an existential threat. Silver is volatile. It can drop 20% in a matter of weeks for no apparent reason. If you're using leverage, that kind of drawdown can force liquidation exactly when you should be holding. The entire point of owning precious metals is insurance and resilience. Leverage defeats that purpose entirely. You cannot be resilient when you're one margin call away from forced liquidation. Buy what you can afford with cash you don't need for other purposes. Build positions slowly with money you can truly set aside. This is the only sustainable approach. High-value portable assets attract unwanted attention. Don't make yourself a target through carelessness. Don't tell people you're accumulating precious metals unless they absolutely need to know. Don't post pictures on social media. Don't brag at parties. Store your metals properly. If you're keeping them at home, invest in a high-quality safe bolted to the structure of your house. If you're using professional storage, verify the facility is legitimate and insured. Update your insurance coverage. Standard homeowner policies often have low limits on precious metals. You may need a separate rider or policy. These precautions aren't paranoia. They're basic prudence. Don't let security failures undermine the wealth you've worked to build. When premiums spike, some people think they've discovered a clever arbitrage. Buy where premiums are low, sell where they're high, collect the spread. In theory, this sounds good. In practice, it's often a disaster for small individual investors. You'll face shipping costs, import duties, taxes, authentication requirements, liquidity challenges, time delays, currency conversion costs. By the time you navigate all these frictions, the arbitrage opportunity may have disappeared, or the spread may be smaller than your costs. Precious metals? Arbitrage is a professional business with institutional infrastructure. Unless you have significant capital, professional connections, and deep expertise, you're unlikely to profit from these spreads. Buy for your own investment objectives. Don't try to become a dealer or arbitrageur unless that's actually your business. Every jurisdiction taxes precious metals differently. Some treat them as collectibles with high tax rates. Some have sales tax on purchases. Some have reporting requirements for large transactions. Failing to understand these rules can result in unexpected tax bills that eat up your gains or even create losses. Before you buy significant amounts of precious metals, understand the tax treatment in your jurisdiction. Factor this into your return expectations and holding period decisions. Tax considerations shouldn't drive your investment strategy, but ignoring them is financial malpractice. When precious metals start moving, the gurus emerge. They've been predicting this move for years, they tell you. They know exactly where it's going. They have special knowledge. Here's the truth. No one knows. The people who claim to know with certainty are the ones you should trust least. The precious metals space attracts charlatans and promoters. Some are trying to sell you coins at huge markups. Some are selling newsletters or advisory services. Some are just seeking attention and followers. Do your own analysis. Form your own views. By all means, learn from knowledgeable sources. But maintain skepticism. Don't surrender your critical thinking to someone else's certainty. The moment you hear guaranteed returns or specific price targets delivered with complete confidence, run the other direction. We've covered a great deal of ground. Let's bring this together with what matters most. The silver premium explosion in India is a signal. It's telling us something about supply constraints, about demand strength, about tensions between paper markets and physical reality. Whether this signal leads to a major bull market or resolves quietly as supply chains normalize, no one can say with certainty. Both outcomes are possible. What we can control is our response, our preparation, our discipline. If you hold precious metals, you hold them for a reason. Unless that reason has fundamentally changed, premium spikes aren't necessarily a reason to abandon your position. They might actually validate your thesis. If you're considering entering the space, don't let premium levels alone determine your decision. Consider your longer-term outlook. Consider your portfolio needs. Consider your risk tolerance and time horizon. Build positions gradually if you're uncertain. Use premium dips to accumulate if that fits your strategy. But don't torture yourself trying to time perfection. The broader lesson here extends beyond silver. We live in an age of monetary uncertainty, of supply chain fragility, of geopolitical tension, of asset price distortions after years of unconventional monetary policy. In this environment, having some portion of your wealth in physical assets that exist outside the financial system is simply prudent diversification, whether that's precious metals, or real estate, or productive land, or other tangible stores of value. This isn't about getting rich quick. It's about preserving wealth across multiple scenarios. It's about having optionality when others might be trapped. The investors who thrive through turbulent periods aren't the ones who make perfect predictions. They're the ones who maintain balance, who avoid catastrophic mistakes, who stay liquid enough to weather storms, and who have the emotional discipline to stick with sound strategies even when they're temporarily out of favor. Silver premiums will fluctuate. Prices will rise and fall. News cycles will create noise and distraction. Your job isn't to react to all of it. Your job is to maintain a rational, well-constructed portfolio positioned for multiple outcomes. That means diversification across asset classes. That means having some precious metals, but not everything in precious metals. That means cash reserves for opportunities or emergencies. That means avoiding leverage and concentration risk. It means staying informed without becoming obsessed. It means making deliberate decisions based on analysis rather than emotional reactions to headlines. Most importantly, it means accepting uncertainty as permanent. We cannot eliminate risk. We cannot predict the future. We can only prepare thoughtfully and respond rationally. The $8 premium in India might mark the beginning of a significant disruption in precious metals markets, or it might be a temporary spike that normalizes in coming weeks. Both scenarios are possible. What matters is that you've thought through how you'd respond to either outcome, that you have a plan, that you're not going to make impulsive decisions in either direction. Write down your strategy, define your allocation targets, set rules for when you'd add to positions or trim them, establish security protocols for whatever metals you hold, understand the tax implications, know why you own what you own, then execute that plan with patience and consistency. Don't check prices hourly. Don't obsess over daily fluctuations. Don't let other people's panic or euphoria pull you off course. Wealth is built slowly, through disciplined accumulation, through avoiding major mistakes, through maintaining your composure when others lose theirs. The precious metals market will remain volatile. That volatility is the price of admission for potentially outsized returns and protection against monetary instability. Your advantage comes not from predicting every twist and turn, but from having the emotional and financial resilience to hold through volatility toward your long-term objectives. If you take nothing else from this discussion, take this. In uncertain times, discipline is your most valuable asset. Not prediction, not perfect timing. Discipline. The discipline to build positions gradually rather than chasing. The discipline to maintain diversification rather than concentrating. The discipline to hold through volatility rather than panic selling. The discipline to stay rational when markets are anything but rational. That discipline will serve you far better than any price forecast or timing call ever could. The silver premium story is still unfolding. We don't know the ending, but we can control our response. We can be prepared. We can be positioned. We can be disciplined. That's all we can do. And honestly, that's all we need to do. Make your decisions deliberately. Execute them consistently. Maintain your discipline across changing conditions. Do that, and you'll navigate whatever comes next far better than those who are reacting emotionally to every market move. Thank you for your time and attention. Stay rational, stay prepared, and above all, stay disciplined.